Something unusual just happened with XRP, a hidden movement in the markets that almost no one is talking about, not a sudden price spike, not another tweet. This involves a quiet buyback, a move of hundreds of millions of dollars, and the implications reach far beyond the price itself. Today, we explore why this event could signal a deeper shift in the financial world, a shift most people have missed. In recent weeks, XRP has shown unexpected behavior. Volume patterns changed, large transfers occurred, and then reports surfaced of a significant buyback, reportedly around $750 million. Such figures are not trivial. This is not retail chatter. This is a scale associated with institutions. But that visible market activity is only part of the story. The real question is why this happened now and what it might mean. Prices move, volume changes. That is normal. But when movements coincide with large strategic actions, we must ask a deeper question. Is something larger unfolding beneath the surface? The reported buyback, if confirmed, is not the kind of maneuver undertaken lightly. A move of this size suggests intent, timing, and preparation. A buyback of this magnitude does not occur in isolation. In public markets, such moves are often a response to perceived undervaluation, structural opportunity, or strategic positioning. Yet, in the world of digital assets, where sentiment and speculation often dominate, this signals a different narrative, a calculated action, not a reflexive reaction. What if this buyback is not merely an isolated corporate financial decision? What if it reflects a broader institutional awareness, a recognition that something in the XRP ecosystem has quietly changed? Large transfers observed on the ledger reflect organized movement, not random trading, not speculative hands flipping positions. These are methodical transfers consistent with strategic accumulation. This is not noise, this is intent. If institutions were simply betting on short-term price appreciation, they would signal through typical market channels. But when strategic entities position ahead of public narratives, the signals are subtle, the movements quiet, and the patterns deliberate. The on-chain data begins to tell a story that most market commentators have yet to decode. For decades, the global financial system has confronted a singular inefficiency: cross-border settlements. Traditional mechanisms are slow, expensive, and opaque. For large institutions, from banks to multinational corporations, these limitations represent real operational friction. XRP was designed to address precisely this type of structural inefficiency. It can settle transactions in seconds. It has bridges to traditional financial systems. It is not just another speculative token, it is infrastructure. Institutions do not accumulate assets because of community sentiment. They accumulate assets when they see a future in which those assets serve a purpose that aligns with institutional mandates: efficiency, compliance, and systemic integration. Consider this: in traditional markets, institutional accumulation often precedes broader acceptance, not the other way around. Early positioning, private negotiations, quiet accumulation. That is how large actors minimize friction and signal strength without triggering premature market reactions. If we observe wallet activity dominated by large structured movements, and if these correspond with reported buyback activity, then the narrative shifts from retail speculation to strategic positioning. This is not about short-term gains, this is about infrastructure adoption. And here is where things start to get more intriguing, but here is where things become even more interesting. Ripple's reported buyback coincides with a period of regulatory discussion in major markets. Not headlines, not noise, meaningful dialogue among regulators, banking institutions, and systemic risk committees. While much of the public discourse around digital assets has centered on classification debates, securities versus commodities, there is a quieter conversation happening behind closed doors, one focused on utility, settlement mechanisms, and systemic efficiency. This is not widely reported. Few analysts have connected these dots, but the timing is unlikely to be coincidental. Regulators have expressed interest in digital assets that provide real-world utility, not just speculative vehicles. Assets that can integrate with existing systems, not disrupt them without coordination. XRP fits this profile. Now imagine institutional actors with fiduciary responsibilities. They are not waiting for clarity. They are anticipating it, positioning quietly, not for hype, but for structural integration. This shifts the narrative from short-term trading to long-term institutional strategy. Large institutional wallets showed activity at times when retail volume was low, not typical trading spikes, but deliberate accumulation windows that coincide with traditional institutional market hours. This pattern is not random. It is consistent with strategic entry, likely executed through private channels, over-the-counter desks, and coordinated transfers, methods institutions use to avoid market shocks. Equally notable, several significant transfers moved funds off major exchanges. When assets leave exchanges in large quantities, it often signals long-term holding, not speculative trading. These are the kinds of data points most market observers overlook. They watch price charts and volume bars. But large players watch structural flows, and the flows in XRP are beginning to tell a story. So what could this mean for XRP and the broader market? First, if institutional players are indeed accumulating strategically, then the landscape of demand could shift dramatically, not based on headlines, not driven by retail sentiment, but grounded in institutional mandates. Institutions ask different questions than retail investors. They do not focus on the next pump. They focus on integration, compliance, and long-term utility. If XRP becomes embedded in institutional settlement frameworks, even on a pilot basis, it would reshape how capital moves across borders. It would change liquidity profiles. It would change counterparty risk models. And it would change capital allocation strategies across multiple asset classes. Second, regulatory clarity, if it surfaces, could further accelerate institutional participation. Financial institutions do not move into ambiguity. They require frameworks, guidelines, and certainty. Should regulators begin to differentiate digital assets by function, settlement versus speculation, XRP would find itself in a unique position, not competing on hype, but competing on utility. Third, the reported buyback itself sends a signal. Buybacks in traditional markets are used to consolidate value, return capital to shareholders, or signal confidence. In digital asset markets, a disciplined buyback of this scale suggests a belief that the asset is undervalued relative to its future role in financial infrastructure. This is a narrative rarely embraced in the broader media, yet it resonates deeply with institutional logic. Now imagine how this could unfold. If institutions continue to accumulate quietly, we could see a gradual shift in market structure, not explosive rallies, not chaotic swings, but measured directional movement. Liquidity could thin on exchanges as more units are moved into long-term holding. Bid floors could rise. Market depth could narrow in ways that favor structural valuation rather than speculation. But beyond market mechanics, imagine the role XRP could play if financial institutions begin integrating it into actual settlement systems. Imagine faster cross-border payments settled in minutes instead of days, reduced counterparty risk, lower costs, greater transparency. These are not fringe concepts. They are core concerns of institutional treasury departments, international banks, and corporate finance teams. If XRP begins to serve these functions, even in a limited capacity, its role in global finance would evolve, from speculative asset to functional infrastructure, and that evolution would alter how investors, institutions, and regulators approach digital assets altogether. We return now to the central question. Did something important just happen with XRP? A large buyback, unusual wallet movements, institutional-style accumulation, quiet regulatory conversations. Taken individually, these might appear unrelated. Taken together, they form a pattern, one that suggests strategic positioning, not random coincidence. Whether this shift plays out over weeks, months, or years, one truth emerges. The narrative surrounding XRP may be far more complex and far more significant than most observers realize. Not just price movement, not just headlines, but structural adoption, institutional strategy, and perhaps a quietly unfolding transformation in how financial systems operate. If this trend continues, deliberate, methodical, unseen by many, then a new phase for XRP could be underway. And when history looks back on this moment, it may not be remembered for headlines, but for the subtle foundational shifts that began to unfold right here. Something has changed, and the world of finance may be taking notice.